Hello and welcome, students. Today we are going to start chapter number 2 of Accountancy, that is, Final Accounts of Partnership Firm. Students, this chapter is very important from the board examination point of view as it carries weightage of 11 marks, one big sum asking the final accounts of partnership firm. You have to prepare the trading account, P&L account, P&L appropriation account, partners capital account, and the balance sheet. By completing the entire answer, you'll be scoring 11 marks. So this chapter is very important from examination point of view. So without wasting the time, let's start with it. First of all, introduction. Similar to the sole proprietor, the partnership firm also prepares its final accounts from the trial balance with the consideration of the adjustments at the end of the year to know the earned profit or incurred loss as well as the financial status of the business. Now, in standard 11th, students, you all have understood or you have all studied the final accounts of sole proprietorship firm in standard 11th. Now, this year you will be studying the final accounts of partnership firm. Mainly the final accounts which we are preparing, that is on the basis of the trial balance that is being provided to us in the question and the adjustments at the end of the year. The main purpose to prepare the final accounts of any business unit is to know the financial status of the business. Let us move on or the understand what are the objectives of final accounts of partnership firm. First one, to ascertain gross profit or loss. Main important idea or main important purpose behind the preparation of final accounts of partnership firm is to know the gross profit or loss, and we are already studied in 11th standard that gross profit or loss will ascertain by preparing the trading account. Then afterwards, to ascertain net profit or loss, same as in sole proprietorship firm, we are preparing P&L account, profit and loss account. In the same way, in partnership firm also we will be preparing profit and loss account to know the net profit or loss. Next one, to ascertain divisible profit or loss. Now this is a new topic over here. All personal transactions and provisions of the partners with the firm can be ascertained through the preparation of profit and loss appropriation account. It means after getting the net profit, whatever the personal transactions that take place between the partners and the firm, to ascertain that we are preparing the profit and loss appropriation account, and whatever the difference that arises of profit and loss appropriation account, that is either divisible profit or loss. Fourth point, to know financial status of the firm. To know the financial status of the firm, balance sheet is prepared. Naturally, if the balance sheet gets tallied, then we understand that our answer is correct. It means through the balance sheet we get the idea about our financial position of the business, about how many assets, payables, liabilities, or capital the firm is having. That idea we can get only by preparing the balance sheet. Fifth and last purpose, that is for taxation purpose. To know the taxable income of the firm, final accounts are prepared. We are already knowing that we have to pay the tax to the government on the income that is earned by the firm. So to decide the taxable income of the firm, final accounts are prepared. So these are the 5 objectives for which the final accounts of partnership firm are being prepared. Now, moving on with the first step that we have to prepare in final accounts of partnership, that is to prepare the trading account. Trading account in sole proprietorship and in partnership firm, almost they are similar. Here, which type of transactions are recorded? We can see to it. Transactions pertaining to receipt and issue of goods, purchase of goods, and production related expenses are recorded in the trading account. It means goods related transactions, whether they are of receipt or whether they are of issue of goods, any kind of production related expenses will be recorded in the trading account, and whatever the difference that comes in the trading account, either it may be gross profit or gross loss. At the debit side, what kind of entries will be written? That is opening stock purchase minus purchase return minus goods going out in any other way, either it may be goods distributed as sample, goods destroyed by fire, or goods given for donation, and so on. Purchase expenses include wages, carriage inward, freight, and production expenses like factory expenses, rent, taxes, electricity, fuel, and so on. Any of the expenses that are related to production that are included in the trading account. And on the credit side of trading account, we are generally writing sales minus sales return, and last entry is generally of closing stock. Always the trading account will be starting with opening stock on the debit side, first entry, and on the credit side, the last entry would be of the closing stock. Now, after understanding, let us understand the specimen of trading account. Now, specimen of trading account, the first entry that I have told, that is to opening stock, then afterwards to purchase minus purchase return, outward of goods maybe in the goods distributed as samples, goods given as donation, or goods destroyed by fire. Any other ways, if the goods goes out of the firm, then they are to be deducted from the purchase. Then afterwards, purchase expenses, it includes wages, carriage inward. Now, what is carriage inward? Carriage inward is the shipping and handling cost incurred by a company that is receiving goods from suppliers. It means it is the shipping cost or the handling cost that is incurred by the company while receiving goods from suppliers. So that is to be recorded in the trading account, but if it is carriage outward, then it is to be recorded in the profit and loss account. Railway freight, transportation cartage, transportation expenses, port charges, if the goods are coming from other country, then port charges we have to pay if they are coming by shipping. Then afterwards, demurrage. Now, what is demurrage and wharfage? These are the two terminologies that are completely new for you. Demurrage means a charge payable to the owner of ship on failure to load or discharge the ship within the time agreed. It means it is a charge that is payable to the owner of ship. Who is the owner of the ship? If we have not collected the goods on time limit from the shipping department, then whatever the extra time that they have kept the goods in their shipping go down, that much time they would collect the charge from us for protecting their goods or for keeping their goods in their shipping go down. So that charge that they will collect from the owner of the ship is known as demurrage. In the same way, wharfage is also one kind of charge that is levied on goods for not removing the goods from the railway department. Even after the expiry, there is certain time limit. During that time limit only, you have to collect the goods from that either railway department or shipping department. But if you are not collecting that goods on the given time limit, then extra charge is being collected by that particular railway department or shipping department. Now, what is the difference between wharfage and demurrage? Demurrage is the charge because on the expiry of the time limit, still you have not collected the goods from that particular department, while wharfage is the charge that is levied by that particular department for keeping that goods in their particular go down as a safety measures till the time you collect the goods from them. So that charges for keeping their goods at a safe place in their personal go downs, that charge is called wharfage. Okay, so that is all the charges related to goods related expenses. That's why they are to be recorded in trading account. Then afterwards, production expenses, production wages, royalty. Now, what is royalty? Legal payment made to an individual for ongoing use of his or her created assets, copyrighted works or franchisee, etc. Now, any of the firm is having the copyright act it has adapted, or it has a franchisee, or it has the ownership or legal authority of any particular assets, and if that person is giving the authority to any other person to utilize his or her assets, copyrighted work, or franchisee, then he will charge royalty from that person. So that is also related to goods only, to his personal assets. That's why it is to be recorded in the trading account. Then afterwards, factory expenses, that means rent, taxes, electricity, and so on. Consumable stores, oil, grease, etc., to run the factory machinery. And then afterwards, to factory depreciation generally we are writing in P&L account, but if it is factory depreciation, then and then only it will be recorded in the trading account. Plant and machinery depreciation, and last is the gross profit. On the credit side, the first entry, that is buy sells minus sales return, buy sell of scrap. Now scrap means any of the waste products, or any of the waste material, any of the newspapers, or any of the metal goods which are non-use, but on selling in scrap we get certain amount in return, so that is the income for the firm due to sell of that scrap goods. That's why it has been included on the credit side of trading account. It means whatever the expenses related to goods, that will be recorded on the debit side, and whatever income related to goods, that will be recorded on the credit side of trading account. Last entry, that is of profit and loss account, that is gross loss. It means if the difference comes on credit side, total of debit side is more and difference comes on credit side, then it is gross loss. It means expense is more compared to income, and this amount of gross loss will be transferred to profit and loss account. In the same way, if there is difference coming on the debit side, it means credit side total is more and difference comes on debit side, then it is gross profit, and that gross profit will be transferring on the credit side of P&L account. Okay, now after understanding the specimen of trading account, let us understand profit and loss account. This is also similar to whatever you have studied in standard 11th. To ascertain net profit or loss, we are preparing the profit and loss account. At the debit of profit and loss account, gross loss transferred from trading account, administrative expense, sales and distribution expense, financial expenses, depreciation on assets, sundry expense, and other losses of the firm are shown. It means on the credit side, on the debit side of profit and loss account, whatever the gross loss that is coming on the credit side of trading account, that we are transferring on the debit side of P&L account. Other than that, we are showing any kind of expenses, whether it may be administrative expense, sales and distribution expense, financial expense, any kind of depreciation on assets, sundry expense, or any kind of losses for the firm, are all recorded on the debit side of P&L account. And on the credit side of P&L account, if there is gross profit, then whatever gross profit that we have written on debit side of trading account, the second entry that will be doing on the credit side of P&L account. Other than that, any kind of income for business, such as interest received, rent received, commission received, brokerage, dividend, etc., this type of any kind of income for the firm, that will be recorded on the credit side of P&L account. Now let us understand the specimen of P&L account, profit and loss account. Already we discussed in standard 11th that how to write the heading, that is profit and loss account for the year ending so and so. Okay, so we have to write always in case of trading account for the year ending, and in case of profit and loss account also for the year ending. Now first entry, that will be of gross loss or gross profit. If it is loss, then debit side; if it is profit, then on credit side. Then afterwards, administrative expenses, it includes trading expenses, salary allowance, bonus, rent, insurance premium, taxes, postage, printing and stationery, any kind of legal charges, audit fees. Now any after at the end of the accounting year, we have to check the books of accounts. For that, we have to give to the chartered accountant for the audit of the books of accounts. So he will charge certain fees for doing the audit of the books of accounts, that is called audit fees. Then afterwards, electricity expenses, contribution to provident fund, it means PF, whatever the PF provident fund, every year the firm is deducting a certain amount every year. The what to say, the any of the employee of the firm deduct certain amount from his salary as a provident fund as a part of PF, in the same way same amount is to be deducted by the firm also on behalf of the employee. So at the end of his time period after he gets retired, he will get this amount of provident fund. So that is one kind of contribution the firm also has to do in favor of the employee. So that is an expense for the firm that is to be done every year. Then afterwards, sales and distribution expense, that is carriage outward. I had already discussed that carriage inward will be recorded in the debit side of trading account, and carriage outward that will be recorded on the debit side of P&L account. Then afterwards, salary, commission, advertisement expense, discount allowed is an expense and discount received is an income. Discount reserve, just as we are creating bad debt reserve, in the same way we have to create discount reserve also. Then after it, expense of showroom, go down expense, packing expense, these are the simple terminologies. The word itself clarifies which kind of expenses they are. Then afterwards, financial expenses, that is to while getting the finance from any of the firm or any of the banking institutes, you have to pay the interest on that finance that you are getting. So over here, any kind of financial expense will be noted down, that is interest on partner's loan. If you have taken the loan from the partner, then you have to pay the interest to them, that is a financial expense. Interest on bank overdraft, now you are knowing what is bank overdraft. Compared to your bank balance, the bank is giving extra amount to withdraw. Whatever the extra amount the bank is giving to withdraw, that is called overdraft facility, and because of this overdraft facility the bank will charge interest on it. Then afterwards, interest on borrowed loan, you are not taken the loan from any of the partner, but you have taken the loan from any of the cooperative bank, then you have to pay the interest on it. Then afterwards, bank charges commission. Every year, many of the facilities bank is providing, so certain amount of commission bank is also charging. Managers commission, these are all coming in the category of financial expenses. And then afterwards, two other expenses or losses, that is donation expense, office assets depreciation. Now this format already, if you remember, we had discussed in standard 11th also. Same format is coming over here, that is to bed debts, trial balance. TB means trial balance, plus bed debts of adjustment, plus bed debt reserve of adjustment. Whatever the total comes of this three value, subtract bed debt reserve of trial balance from it, and whatever the final answer comes after deduction, that you have to show in the outer column. Again repeating, this format you have to apply each and every time in almost all the sums in practical questions. So again revising this format, that is bed debts of trial balance plus bed debts of adjustment plus bed debt reserve of adjustment, total of it, subtract from it, minus bed debt reserve of trial balance. Whatever the difference comes, that you will write in the outer column. And afterwards, any kind of loss, whatever the expenses that we have written, that is administrative expense, financial expense, sales and distribution expense. Now any kind of loss to the firm, that is loss due to fire, loss due to theft, loss on sale of assets. Suppose goods destroyed by fire and the insurance company has accepted the claim of certain amount. Suppose goods are destroyed of 50,000 and insurance company has accepted claim of rupees 40,000. Never the insurance company will accept the claim of the entire amount of goods destroyed. Okay, so the insurance company has accepted claim of only rupees 40,000. So difference, that is of 10,000, that is called loss for the firm, loss due to fire. So that will be recorded on the debit side of P&L account. Same way, loss due to theft, loss on sale of any kind of assets. If the assets value, that is rupees 50,000 and you have sold it for rupees 40,000, so 10,000 loss has occurred due to sale of any of the asset. Provision for expense or losses, and the difference, if the difference comes on the debit side, it means credit side total is more, then it is called net profit, and this net profit will be transferring to P&L appropriation account. Okay, so after preparing the net P&L account, the next account that we have to prepare, that is profit and loss appropriation account. If the difference comes on debit side, then it is net profit. Okay, now let us have a glance over the credit side of P&L account. First entry, that would be gross profit. Then afterwards, any kind of income, that is discount received, rent received, commission received, brokerage received, consignment commission received, any kind of contract, any kind of consignment has been completed, any kind of deal has been completed, then you are getting commission for completion of that consignment. Then afterwards, interest on investment. If you have done any kind of investment, then you will be getting interest, so it is an income for you. Then afterwards, interest on loan lent. If you have received the loan, then you have to pay the interest, and if you have lent the loan, then you will receive the interest. Bad debts return, it means previously it was considered as bad debts, now it has been recovered, so you can write bad debts return also, or it can be called bad debts recovered also, so it is one kind of income for you. Profit on sale of assets, just as loss on sale of asset is to be recorded on debit side of P&L account, same way profit on sale of assets is to be recorded on credit side of P&L account. Sale of old newspapers, income from scrap, sundry income, and last one, that is if the difference comes on credit side, then it is net loss, and it is to be recorded on the debit side of profit and loss appropriation account. So now, after understanding the format or specimen of profit and loss account, let us understand the new topic for you for this year, that is profit and loss appropriation account. Now, to disclose the distribution of profit and loss between the partners, profit and loss appropriation account is prepared in a partnership firm. It means whatever the profit that has been earned by the firm, to distribute or to disclose that distribution of profit and loss amongst the partners, profit and loss appropriation account is prepared. Okay, so at the debit side of profit and loss appropriation account, net loss transferred from profit and loss account, interest on partners capital, interest on credit balance of current account, bonus, commission, salary and remuneration to partners, amount transferred to general reserve account are shown. It means on the debit side of profit and loss appropriation account, profit, net profit available from P&L account will be there. Then afterwards, interest on partners capital, interest on credit balance of current account. If there is current account also, then whatever the interest on that current account will also be recorded on debit side. Any kind of bonus, commission or salary that is payable to any of the partner, or remuneration that is payable to partner, then it will be recorded on the debit side of P&L appropriation account. Now, what kind of entries are recorded on the credit side of P&L appropriation? That is net profit transferred from profit and loss account, interest on drawings of partners, interest on debit balance of current account, etc. are shown. It means at the debit side, whatever the interest that is receivable by the partner, whether it may be interest on partners capital, interest on credit balance of current account, any kind of bonus, commission, salary or remuneration that is receivable by the partner, that are recorded on the debit side. And on the credit side, that is interest on drawings, interest on debit balance of current account, that are shown. It means on the debit side, again repeating, interest on partners capital, it means whatever the partner has given the capital, on that the interest is charged, so it is recorded on the debit side of profit and loss account. Okay, and on the credit side, if it is drawings means if the partner has withdrawn certain amount of money, cash or any kind of assets from the firm, then interest is charged on that drawings. Okay, so that type of entry will be recorded on the credit side of profit and loss appropriation account. And whatever the difference that comes of the profit and loss appropriation account, that is called divisible profit or loss. So now let us understand the specimen of profit and loss appropriation account. Same for heading we have to mention as we are mentioning in trading account and P&L account, that is P&L appropriation account for the year ending so and so. Now, first of all, on the debit side, the first entry that would be always of net loss that we have got from the profit and loss account. And on the credit side, if there is net profit, then it will be on the credit side of P&L appropriation account. Okay. Next, debit side, all the entries related to interest on partners capital, interest on credit balance of current account. If the current account credit balance is there, then interest on current account of credit balance will be noted down on debit side. And if there is debit balance of current account, then it will be recorded on credit side of P&L appropriation account. Then afterwards, salary, bonus, commission or any kind of remuneration to the partner, then it will be recorded on profit and loss appropriation account debit side. Okay, and general reserve distributed amongst the partners, so it will also be recorded on the debit side of profit and loss appropriation account. Now credit side, first entry always it will be of net profit, then afterwards interest on partners drawings. And we already discussed that if it is credit balance of current account, then interest will be recorded on debit side, and if it is interest on debit balance of current account, then it will be recorded on credit side. Now after posting of all the entries, we have to find the difference. If the difference comes on credit side means total of debit side is more and the difference comes on credit side, then it is divisible loss. And if the credit side total is more and the difference comes on debit side, then it is divisible profit. Now whatever the profit that comes, that is to be distributed amongst all the partners in their profit and loss sharing ratio, that will be given to you in the question. Suppose here it is given A and B, two partners. If there may be three partners, then 3 is to 2 is to 1 ratio is given to you. Then whatever the divisible profit comes, that is to be distributed amongst the three partners, that is A, B and C, in the ratio of 3 is to 2 is to 1. Okay, so that was the topic that I wanted to explain of the P&L appropriation account. After preparing the P&L appropriation account, whatever the profit that came, divisible profit that came of each of the partner, that is to be distributed in the profit and loss sharing ratio and is to be transferred to their partners capital account. Now what is partners capital account? Partners of a partnership firm undertake personal transactions with the firm. There are many transactions or dealings that are in between the partner and the firm. Generally this partners capital account or partners current account we were not making in case of sole proprietorship firm, but here the, because of having partners, because of partnership firm, we have to prepare partners capital account, because there are many transactions, personal transactions in between the firm and the partner. To record such personal transactions between the firm and the partners capital account is to be prepared. Okay, so first of all the opening capital of partner is written at the credit side of the capital account, and subsequently if additional capital introduced, it also credited. Always in partners capital account, let us see at the specimen of the partners capital account. Always on the credit side of partners capital account, whatever the opening balance that would be given to you in the question, that is to be recorded of the partners. Okay, so by balance brought down, that is the starting opening capital that would be given to you in the question. Then afterwards any kind of additional capital, if in between of the year any of the partner is bringing that, then also it is to be noted down on the credit side of partners capital account. As we are recording capital on the credit side, same way any kind of withdrawal, that is drawings, then it will be recorded on the debit side of partners capital account. You can see debit side first entry, it is there to cash or bank or the other assets. Withdrawal of capital means any kind of withdrawal of capital, whether it may be in the form of cash or any of the asset, then it is to be recorded on the debit side of capital account. Now after partners capital account will be, suppose here there are only two partners. If there are three partners, then we have to make three columns, that is for A, B and C. It means combined partners capital account we are preparing. Now after posting of all the entries, that is of the capital and of the drawings, we have to close the partners capital account. Okay, so for closing, if the difference comes, generally the difference comes on the debit side, it means total of credit side is more, so that is called the closing balance of capital of the partners. Okay, so that capital will be noting down in the balance sheet. Over here see I've written, it has been written that is 31st March to balance carried down, that is closing credit balance of partners. So that will be recorded on the liability side of balance sheet. Okay, now after understanding the partners capital account, let us understand what is partners current account and why it is to be prepared. That is also to be prepared to record the personal transactions between partners and partnership firm other than the permanent capital. Now Now, what type of transactions are recorded in partner's current account? Now, one thing, make it sure partner's current account is prepared only and only if the balance of current account is given in the question, opening balance of current account is given in the question of the partners. Then and then only partner's current account is to be prepared. Otherwise, all the other entries related to partners will be recorded in partner's capital account. Okay. Now, let us see what kind of entries are to be recorded in partner's current account. At the credit side of partner's current account, opening credit balance of current account, as we are writing the opening balance in case of capital account. Same way, opening credit balance of current account on credit side of partner's current account. Interest on capital, interest on credit balance of current account, salary, bonus, commission, and bonus to partners. Share in divisible profit, whatever divisible profit that we have got from the P&L appropriation account, that will be transferred to partners current account. Okay. And on the credit side, and on the debit side, if there is any kind of drawings, interest on debit balance of current account, share in divisible loss, that are recorded on the debit side of current account. Okay. Now let us understand the format of or the specimen of partners current account. As you can see on your screen, that is debit side, the first entry, that is if it is debit balance of a current account, then it will be recorded on the debit side, and if there is a credit balance of current account of any of the partner, then it will be recorded on the credit side. So first entry will always be of opening balance, whether it is debit balance or credit balance. Then afterwards, on the debit side, or any kind of drawings, interest on debit balance of current account will be recorded on debit side. And on credit side, capital, interest on credit balance of current account, any kind of salary, bonus, commission, or remuneration, that is one kind of income for that particular partner, but we are recording in P&L appropriation account on the debit side, because from the firm point of view, it is an expense that is to be paid by the firm to the particular partner. Okay. So it will be recorded on the debit side of P&L appropriation account and on the credit side of partner's current account. Okay. And last, that would be divisible profit or divisible loss. If on the credit side, we'll be writing divisible profit, whatever the difference that comes on the debit side of P&L appropriation account, second entry, that will be writing on the credit side of partner's current account. In the same way, if there is divisible loss, then we'll be writing on the debit side of partner's current account. Then afterwards, we'll be closing the account. If the difference comes on credit side, if the total of credit side is more and the difference comes on debit side, then it is called credit balance. Whichever side's total is more, that type of balance. If the total of credit side is more, then it is called credit balance, and if the total of debit side is more, then it is called debit balance. Okay. See over here, it is written on the debit side, it is written closing credit balance. Closing credit balance means it is the difference that has came, or the closing balance that has came, that is credit balance, because total of credit side is more and difference comes on debit side. On the other hand, if the total of debit side is more and difference comes on credit side, then see, you can see in the last entry on the credit side, that is by balance carried down, closing debit balance. It means total of debit side is more, then difference would come on the credit side of partner's current account. Note is very important over here. All items of current account will be shown in the capital account when current accounts are not given in a question. Already I have told that current account is to be prepared only and only if the balance of current account is given to you in the question of the partners. If there is no any entry related to current account, then all the entries related to partners will be given in the capital account only. Okay. Now the last thing that we have to prepare in the final accounts of partnership firm, that is balance sheet. To know the financial status of the firm, balance sheet is prepared at the end of an accounting year. Now at the end of the accounting year, the last step is the balance sheet, to know the financial position of the business. Balance sheet is a statement. Whatever we have prepared till now, that is trading account, P&L account, all are accounts, but balance sheet is a statement, where on one side amount of capital and liabilities and on the other side amount of assets are disclosed. You are knowing the format of balance sheet already, we had studied in standard 11th, that is on the debit side, on the left hand side we are writing the capital and liabilities, and on the right hand side that we are writing assets and receivables. Okay, now what type of assets are to be recorded? That is fixed assets, investment, current and liquid assets like closing stock, debtors, cash balance, bank balance, bills receivable, prepaid expense, loan lent, deferred revenue expense, debit balance of current account, etc., are disclosed on the asset side of balance sheet. And on the capital or liability side, the credit balance of current account, bills payable, bank overdraft, outstanding expense, income received in advance, interest on partners loan, loan borrowed, these type of entries will be disclosed on the liability side, capital liability side of the balance sheet. Now, let us understand the last topic of today's video lecture, that is the specimen of balance sheet. You can see on your screen that is balance sheet as at. You have to write over here balance sheet as on or as at. You cannot write balance sheet for the year ending. Okay, so be careful while writing the heading of the balance sheet. The left hand side that we are writing capital liability side, and the right hand side that we are showing as the assets. The format is very simple: capital liability amount rupees, assets amount rupees. Okay, the first entry that would be of fixed capital account, and that is of partner A and B. A current account, if in the question it is given credit balance of current account, then it will be recorded on the liability side. Reserves, any kind of reserve, that is general reserve, capital reserve or other reserves. Non-current liabilities, now you are knowing very well what are current liabilities and what are non-current liabilities. Current liabilities means which are payable within the time limit of 1 year, and non-current liabilities are those liabilities whose time limit is more than 1 year, which are not payable immediately, that are called non-current liabilities, such as loan from bank, loan from any of the financial institutions. If you have taken the loan from bank, then actually within a year you don't have to pay that amount of loan. Minimum 5, 10, 15, 20 years amount of loan is there. Okay, partners loan, all that are coming in non-current liabilities. Then afterwards current liabilities, that is bank overdraft, sundry creditors, bills payable, expense outstanding. Already we discussed in standard 11 these terminologies, that is outstanding expense, income received in advance, taxation provision. That is naturally will be doing for a year only, because at the end of the year we have to make the payment of the tax. Provident fund, provident fund, that is a liability, but if it is contribution to provident fund, then we will be recording on the debit side of P&L account. Outstanding interest on any of the partners loan, then these are included in current liabilities, which are payable within the time limit of 1 year. Now after completing the liability side, let us look at the asset side. First entry, that is of non-current assets, that is fixed assets. In that there are two parts in fixed assets, that is tangible assets and intangible assets. Tangible assets means those assets which we can see and touch, while intangible assets are those which we cannot touch and see but whose value is being measured. That's why they are called as intangible assets. Okay, tangible assets, any kind of fixed assets, that is land, building, any kind of leasehold property, vehicle, machinery or furniture, that are included in tangible assets. Intangible assets means patent, trademark, copyright, goodwill, that type of assets which we cannot see and touch, that are included in the category of intangible assets. So always the asset side will be starting with first with the fixed assets. Then afterwards second will be coming of the investment, any kind of investment made by the firm in any of the government securities on or in provident fund, then it will be recorded on the asset side of balance sheet. First step would be of fixed assets, second one that would be investment, third one that is non-current assets, and the fourth one that would be current assets. Non-current assets means deferred revenue expense. Suppose advertisement expense is there, and that benefit of advertisement expense you are receiving for 5 years, and total expense that is 50,000. So 50,000 you will be showing in the inner column and divide by 5, so it would come 10,000. So you will be subtracting 10,000. In the outer column you will be showing rupees 40,000. So that type of expenses whose benefit is to be available for more than a year, then that are called deferred revenue expense, and they are included in the category of non-current assets. Then afterwards current assets, it includes closing stock, sundry debtors who can be easily converted into cash within the time limit of 1 year, that are called current assets, such as closing stock, debtors, cash balance, bank balance, income due, loan lent, bills receivable, prepaid expense. all these are coming in the category of current assets. Then afterwards, if there is debit balance of current account of any of the partners, then it will be recorded on the asset side, and if there is credit balance of partners current account, then it will be recorded on the liability side. At the end, both the side, that is liability and asset side, should get tallied. If the total of both the side comes equal, it means our answer is correct. If the total of both the side gets tallied, both the side total is coming equal, it means our answer is correct. So that was the last topic that I wanted to explain. So students, today we have cleared all the specimens of final accounts of partnership firm. In the next video lecture, I'll be explaining you the adjustments related to final accounts of partnership firm. Till then, keep practicing. Goodbye. Stay blessed.